Welcome back to Story University Lesson 10, Smart Business Organization to Raise Your Wealth. I'm Chris Volk, CEO of Store Capital, and in the first two parts of this lesson, we've explored ways in which you can start or buy a business with little down. In our previous chapter, I illustrated an example where you could control 80% of a business while putting up just 25% of the money. You want to control 90% of the company with just 10% down? No question, this is achievable. Maybe you want to put nothing down. Hard, but definitely not unheard of. One small pearl of wisdom from Mort Fleischer, a serial entrepreneur I've worked with for many years and who served as chairman of all three companies I've helped guide. Owning at least 51% of a company that you create is the best. There have been several times in his experience where majority ownership became important. A number of years ago, a customer of ours actually prepared a plaque for Mort, memorializing his model for starting a business, and it goes like this. Operating cash flow divided by other people's money equals infinity. Mort started a number of successful companies with little of his own money. And so with OPM coming from lenders and minority shareholders, his shareholder rate of return was simply infinite. So let's say that you have figured out how to harness capital from a selling shareholder, or how to raise a majority of the capital that you need from minority shareholders. Well, you're not done yet. One of the key things to consider is offering yourself a means of eventually buying out minority investors who are helping you by putting up most of the cash you need. Generally speaking, your minority shareholders should be open to this. After all, minority investments in private companies are illiquid, and so your investors are going to be looking for a way to eventually exit their investment with a profit. One way to do this is with a set purchase option that can be exercised after a certain date. In the example in our last chapter, we presumed an eventual sale of your business at a multiple of around 5 times equity cash flows. A 5 times multiple equates to a current return on equity for the minority shareholders of 20%. And that's irrespective of what the actual current ROE of the company is, which you can determine with the V formula. But you can alter the example to enable you to value the company at 5 times equity cash flows and then to pay out 20% of this value to buy out your minority investors who, in our example, put up 75% of the equity capital for a 20% company stake. Keep in mind that the deal you struck with them in the prior chapter, which was the valuation proceeds they get, are conditioned upon them receiving a minimum of all of their money back and a 10% internal annual rate of return on their investment. So as noted in our last chapter, this can mean that your outside shareholders could be entitled to greater than 20% of the valuation if your equity rates of return are not sufficiently high. Now, how do you pay the shareholders off? Well, many company founders look to banks or other conventional sources of capital that should be available to you with a well-established business and a solid track record of performance. A second option that's often used is to have those minority shareholders take back a promissory note. Having an ability to unwind your initial shareholder mix is really important. And many entrepreneurs overlook this important step of corporate organization and they come to regret it. When it comes to putting together the equity ownership of your company, simpler is better. Having a single consolidated company with a single set of financial statements that can be read and evaluated by banks and other lending institutions is the best. But sometimes this is not possible. If you're in a business that employs multiple locations, such as a restaurant, fitness center, or a retail establishment, you may find that growth creates stress on your minority shareholders. The equity investors that put up 75% of the shareholder capital to get you started in the first location may just be tapped out if you need equity capital for subsequent locations. In such a case, you may find that you have to reach out to other equity investors, but that your initial equity investors do not wish to allow them to invest in the first company you created. Plus, you have a deal with those initial investors that could be muddied up with the addition of new shareholders. So, you elect to start a second company for the second location using a similar deal structure. Now, actually, you can try to use progressively more advantageous deal structures given the fact that you're now proven and that your vision is a successful one. So think of this. You now have multiple locations, each one owned by a separate mix of investors. In such a case, you're going to want to create a management company that you completely own that provides services to each of the locations of the businesses that you have created. In trying to think ahead, it would have been wise to think about creating a management company with the very first location, one that charges a fee for managing that location in a way that's satisfactory to your minority investors. But now you've gone from a single consolidated company with a single main checking account and a single financial statement to multiple companies with multiple checking accounts and multiple financial statements. If you're looking for a bank to finance your business, such a complex structure makes this harder. You needed to do it to raise the equity capital required, but you can end up with a Rubik's Cube of a corporate organizational structure. I've known many companies that have needed to go this route to start their very first businesses, some of which even went public. In all cases I can think of, the ability to buy out the minority investors was important in order to combine all the locations into a single, efficient, simpler corporate entity. In some cases, rather than buy out all the shareholders, the founder convinced all of them to consolidate their entities, with each shareholder exchanging their shares for a single location for shares in the overall business. Basically, the corporate founders were able to recut the deal. Multi-location businesses like restaurants, health clubs, early childhood education, and retail establishments can result in shareholder organizational complexity. They also often tend to be real estate intensive, in that each new location entails the acquisition of a new building. As a general rule, as noted in Lesson 7 of Story University, leasing real estate tends to offer many advantages over real estate ownership. Now, businesses elect the latter require added shareholder equity because 100% real estate debt financing is simply unavailable. For companies electing to own their real estate locations, corporate organizational complexity can increase still more, because often real estate is held in separate companies and then leased back by real estate shareholders to the operating businesses. The motivation for doing this is to shield income through real estate depreciation, which is essentially a long-term tax deferral. In many cases, I've seen company founders derive most of their income not from their corporate dividend distributions or salaries, but through real estate rental streams from the business locations. As with my earlier comments, the desirability of control and minority share purchase options stand also for the real estate entities you create. But the real estate holding companies that you create tend to be less important, since your wealth is most likely to be delivered from the value of the business operations themselves. And indeed, that's generally the experience and evidence from the Forbes 400 list of America's richest people. And here we are at the conclusion of 10 lessons designed to illustrate the fundamentals of personal and business wealth creation. My approach to this topic has been quantitative and even somewhat linear. But the world businesses operate in can be far from linear, and a quantitative understanding is only useful if a company is well led. You and a talented staff are what make the numbers happen and wealth creation possible. I'm Chris Volk, thanking you again for joining me on this value creation journey.